In Lesson 4, we will unpack the various mechanisms by which catalytic capital enables outsized impact. To begin, let's discuss the forms of catalytic capital and how they enable impact. The framework that we'll present is called the 5 Ps, and it comes from an important Tideline report released in 2019. The first P is price, accepting an expected rate of return that is below market relative to the expected risk. This is in relation to what commercial investors will do. Patience, accepting a longer or especially uncertain time period before an exit. A subordinated position or undercompensated risk. For instance, some investors take an equity or junior position in the capital stack that pays the same interest rate of a senior loan so that they can unlock commercial investors to invest in the senior position. Pledge consists of using guarantees to unlock more capital. For instance, you may be familiar with MC Social Capital, the same investment that was introduced by Sayuri Sharper in Lesson 3, that has a note program that is guaranteed by investors who pledge some of their assets to cover for potential losses of the MC portfolio. Chances are that if MC's portfolio does well, the guarantees will not be needed, but if there are some portfolio losses, they will be covered proportionately by all guarantors. And finally, purpose. Accepting non-traditional terms to meet the needs of an investee, for example, unconventional or no collateral, self-liquidating structures, smaller investment size, higher transaction costs, and so on. The same report also identifies 3 specific roles for the deployment of catalytic capital that are tied to the stage of development of a company or potentially fund. The first one is seeding and early stage innovation. Then scaling by realizing economies of scale and reaching new geographies and population segments that commercial capital alone will not fund. Especially at this stage, catalytic capital can also be used to de-risk an investment proposition and leverage investments from third-party investors, maybe in a senior position, to achieve greater scale. And finally, sustaining an investee that requires a subsidy on an ongoing basis, for instance, to preserve the mission of a company in the long run. Let's explore some of these concepts through case studies so we can really bring them to life. Let's start with an equity case studies by Zikiza Healthcare Limited. The company provides emergency medical services to bottom the economic pyramid consumers in Mumbai through 24/7 call centers, ambulance services, and personnel training. One of the key innovations of Zikiza is a sliding price scale to determine patient fees based on the customer's ability to pay. Their first service was dial 1298 for an ambulance. In 2007, Acumen Fund made a $1.5 million equity investments to support the development of 1298. Acumen Fund investment assumed greater risk and the financial return will justify for these investments, providing growth capital at a critical juncture in the company development. An equity investment was deemed an appropriate means to demonstrate the financial viability of providing affordable healthcare services to very low-income consumers. And as a result of these investments, Zikiza went from 10 to 70 ambulances in 2 years. It bolstered its senior management and improved service quality. The long-term nature of this equity investment also gave the time to Zikiza to refine its operating model and gain market traction. The catalytic capital role in this instance was to seed early-stage innovation. At this stage, the enterprise model had not been validated yet, and it was extremely risky to invest. Nevertheless, Acumen helped Zikiza validate it and be able to enter a path of scale. There are also 2 forms of catalytic capital in this situation. A price component, because the risk profile of this investment is not justified by the potential financial return, and a patient component, because of the liquid nature profile of the equity investment. Next case study is a private debt case study in HCT Group. This is a UK-based bus operator that uses its surplus commercial vehicles to provide training and community transport services for those that are unable to use conventional public transport due to mobility issues. In 2010, British Social Entrepreneurs Fund structured a social loan of £1 million for HCT to help meet the enterprise medium-term capital requirements. Investors would receive coupon payments that will increase by 1% for every 1 million increase in revenue of the company. The annual interest payments were capped at 20% of the loan amount. The terms of the investments provided HCT with a flexible capital to bid for and operate more bus routes as a part of its plans to expand, and an ambition to compete with private sector providers. HCT reported this round of investments allowed it to increase the turnover by nearly 20 million British pound and provided investors a return of 7%, and it continued to raise an additional 10 million investment to date. The Catalytic capital role in this instance was to scale up an existing business, and HCT Group was already operating but needed to expand its routes to reach the necessary scale to compete in the market with commercial players. The component of catalytic capital includes price, because the interest rate is capped based on the increase in revenue, and purpose, because of the conventional deal terms to align the company and investors' interest. The next case study is the National Housing Trust, which is a US-based nonprofit engaged in creating and preserving affordable housing through policy advocacy, real estate development, and lending. In 2016, the Kreisky Foundation provided 6 million program-related investment in the form of debt with a 10-year term, additional grant support, and the potential to convert the debt into an equity investment. For those of you who are not familiar with program-related investment, it's a type of investment used by US foundation that can provide and counts towards their annual minimum distribution minimums. The loan positioned the National Housing Trust as a more competitive buyer in the fast-moving housing market by providing with enterprise-level capital, which enabled the organization to respond more rapidly to market opportunities, as opposed to having to fundraise at the individual project level. The catalytic capital investment allowed the NHT to pursue apartments in high-opportunity neighborhoods where it could then offer some portion of the renovated units to families with Section 8 housing vouchers. This is affordable housing. The NHT developed a strategy to demonstrate the viability of mixed income housing in high opportunity neighborhoods, using existing buildings and without the need for additional subsidies. The catalytic capital role in this instance is to sustain the company mission in the long run. Affordable housing requires renting below market prices, and it's a long-term play. The loan in this instance was a 10-year term to support this need, with the potential to convert in equity, and it was coupled by grant support as well. There are also 4 forms of catalytic capital in this situation. A price component, because this is a program-related investment which cannot be motivated by financial returns. Patience component, because of 10-year term. A position component, because the debt is at the company level as opposed to the property level, such as a mortgage that is a first lien on a property, and potentially convertible into equity. And finally, there is a purpose component because of the conventional deal terms. Now that we have looked at these examples, let's also hear from one of the leading catalytic capital investors out there. We were lucky enough to get a recording from Jacqueline Novogratz, the CEO and founder of Acumen Capital, which I believe most of you know as one of the leading institutions when it comes to catalytic capital. So let's hear from them what catalytic capital enabled them to achieve in the course of 20 plus years.
"21 years of doing this type of catalytic patient investing has taught us that there are 4 main reasons for using catalytic or patient capital. Number 1 is new market creation. In many areas of the world, particularly when it comes to very low income people, markets don't even exist. There's no better case in Acumen's history than off-grid solar energy. When we made our first investment in 2007, 1.5 billion people had no access to off-grid solar. We didn't understand then that not only were we dealing with very, very low income people, but there was no infrastructure, there was no real financing. There was a lot of bureaucracy, corruption, complacency, diesel mafias, kerosene mafias who had no interest in seeing a new market created. Patient capital, catalytic capital was critical to build that ecosystem. The second is in very low trust communities, which we now see all over the world. We work in post-conflict areas in northern Uganda, in Colombia. It takes time to build the capabilities and the trust of people for whom markets have never really worked and for whom there's very little reason to trust. The third is in those areas where government has failed and yet the private sector alone will not suffice to solve a tough problem. Whether that is toilets or water or healthcare or education, we need more blueprints of public-private partnerships. Patient catalytic capital enables investors and entrepreneurs to build the models, the blueprints for how we can take these ideas sustainably, profitably to scale. And then finally, we're at a moment where capitalism needs to be reimagined, and that includes making our supply chains more equitable, sustainable, and just. And patient capital, catalytic capital, enables entrepreneurs to experiment. Again, build the trust, create the new kinds of linkages across different stakeholders to build a more robust supply chain that truly includes those who for too long have been overlooked or left out. Those are the top 4 reasons for where patient catalytic capital is absolutely critical to building the kinds of solutions we need. 21